Money pulses through every society like a living current, shaping customs and ambitions. I invite you to walk beside it as it moves from the first primitive exchange of need to today's intricate tapestry of finance. In the quiet of my mind, I hear ancient markets where people gathered with grain balanced on shoulders, hoping a farmer's surplus might match a weaver's cloth, while hunters offered meat for tools. Each trade stalled when the double coincidence of wants faltered, when stale bread could not be split for half a loom, when perishable fish rotted before a carpenter could fashion a door, and when the value of a woven basket seemed forever elusive against the weight of a cow. Those inefficiencies, no standard measure, no safe store of wealth, endless search for mutual desire, kept many wants unmet. I picture early stalls where salt crystals glimmered in traders' hands, their uniform grains turning an essential seasoning into a reliable token. I hear the lowing of cattle moving through village squares, each animal marked by weight and health, making them trustworthy units for barter. I feel smooth shells pressed palm. In those moments humanity first discovered that a commodity could become a common language of worth. Salt, cattle, shells, embodying physical certainty that turned fleeting desire into measurable trade. The shift to metal coinage marked humanity's first step toward a universal medium, whose credibility rested on two inseparable principles: intrinsic worth and sovereign stamp. Gold, silver, bronze possessed durability, divisibility, luster. They embodied value in themselves, allowing trust without endless negotiation. Each coin bore a carefully minted emblem proclaiming the ruler's authority, turning simple metal into an unquestionable promise, backed by state power. This dual foundation, substance and imprint, created shared confidence that could travel across markets and borders. In song, Afro-China merchants once bore heavy coins upon their backs. A sage imagined value need not be bound by iron, but could be inscribed on thin sheets of paper, a whispered promise rather than weighed metal. They drafted simple notes declaring, "I owe you this amount," trusting the community to accept these written vows as if they were coins themselves. In their hands, paper became a vessel of intention, letting trade flow like wind through bamboo groves without burden. It was not merely paper, but a covenant that turned the weight of metal into the lightness of recorded assurance. Medieval European market squares echoed with handwritten notes serving as receipts for deposits, pledging to pay the bearer on demand. These promises traveled from hand to hand, gaining trust because the merchant's reputation stood behind them, allowing traders to settle debts without moving heavy coins. Simple promises became a circulating medium that expanded trade routes and funded ventures across continents. Modern banking stands as a silent engine, gathering scattered savings into vast reservoirs of capital. These pooled deposits are transformed into streams of credit for entrepreneurs, innovators, households alike. By extending loans rooted in collective trust, banks become architects of progress, empowering new ventures, expanding infrastructure, lifting communities toward prosperity. In every transaction where a borrower receives funds and a lender relinquishes savings, the promise of growth is realized. A quiet partnership that fuels economies and reshapes markets. In my mind, I see a bank vault holding just a sliver of every deposit. The ledger whispers that the rest can travel farther than its walls. The institution trusts only a modest portion will be withdrawn at any time, so it safely expands credit while preserving enough liquidity to honor promises. In quiet chambers of power, sovereign authorities gather the right to shape money itself, appointing guardians who watch over its flow and ensure prices do not swing wildly. They craft rules that dictate how much currency may be printed, how interest is set, how banks borrow when markets tremble. All to keep the economy's heartbeat steady, to protect savings from sudden loss, to give citizens confidence that tomorrow's purchasing power will not evaporate like mist in a storm. By standing ready as lenders of last resort, they inject liquidity at moments of crisis, mending broken credit chains. Before they can choke trade. Through open operations they nudge borrowing costs, up or down, coaxing investors and consumers into balanced decisions that smooth peaks and valleys alike. I see the gold standard as a pact of certainty. Nations tethered their currencies to a fixed amount of gold, agreeing on unchanging exchange rates that smoothed trade and curbed inflation. This promise held for decades, binding economies together in a stable lattice of value. Yet when war erupted, the pressure became unbearable. Governments could no longer defend precious metal reserves against mounting fiscal demands, and they were forced to abandon the tie, shattering the fixed-rate framework that had once anchored global commerce. When I observe governments minting paper and decreeing it legal tender, I see its worth not stemming from any physical reserve, but from sovereign proclamation alone. Citizens are bound to accept these notes in every exchange because the state has declared them universally payable. This declaration creates a shared belief that the currency holds value, an invisible contract sustained only by collective confidence of a populace who trust tomorrow's markets will honor today's promises, making public faith the true foundation of fiat money. I stand at the helm of policy where levers are threefold and precise: open market operations, buying or selling securities to inject or withdraw liquidity; reserve requirements dictating how much capital banks must hold against deposits; interest rate targeting steering borrowing costs up or down. Each tool is a calibrated instrument capable of accelerating growth when the economy falters, or cooling overheated markets before excesses spiral out of control. Together they form the rhythmic pulse that guides economic activity toward stability, ensuring credit flows where needed, prices remain anchored, and overall momentum aligns with broader societal goals. The rise of financial markets unfolds as a story of expanding pathways through which surplus savings become productive ventures. First shares granting ordinary investors stakes in burgeoning enterprises. Then bonds binding governments to future repayment promises. Commodities entered this lattice, offering tangible anchors for speculation and hedging, while allowing producers to lock in prices far ahead of harvest or extraction. Together, these instruments wove an intricate web where capital could be pooled, risk distributed across diversified portfolios, and ambition financed without relying solely on personal wealth or executions into concrete investment opportunities that propelled innovation and growth. I stand before you at moments when markets ignite with fervor, when optimism swells beyond reason, turning ordinary assets into objects of obsession. History shows us tulip mania in 17th century Holland, where flowers were priced far beyond any rational utility, driven solely by collective excitement. The South Sea bubble, where shares soared as investors chased imagined fortunes while ignoring balance sheets and the dot. In each case, euphoria rewrote fundamentals, inflating prices until the bubble burst. A stark reminder that when desire outpaces reality, markets can collapse with brutal finality. Imagine standing at the edge of a market where every transaction feels like stepping onto a bridge made of promises. Derivatives are precisely those bridges, contracts that echo price movements of something else, be it crops, currencies, or stocks. They do not own the underlying asset themselves, yet they mirror its fluctuations so closely that a single shift can ripple through the agreement and alter fortunes in an instant. This mirroring magnifies risk. When the world turns volatile, derivative values swing wildly, amplifying losses as quickly as gains. Yet for those who understand their language, the same mechanism becomes a shield, an intricate hedge that offsets exposure to unwanted price movements, allowing farmers to lock in harvest prices, investors to neutralize currency swings, speculators to navigate uncertainty with calculated precision. In this delicate dance, every party must constantly assess how their position will react when the underlying asset trembles, balancing amplified risk against the reassurance of a well-crafted hedge that can transform potential catastrophe into manageable exposure. The fault lines leading us into ruin are clear. Reckless extension of credit to borrowers who could never repay. Endless multiplication of positions through leverage, turning modest bets into towering exposures. Glaring gaps in oversight that left the system blind to its own collapse. Together these forces forged a perfect storm, where mortgages once celebrated as opportunities became the catalyst for a crisis that reshaped finance forever. Reforms enacted after the collapse reshaped banking by imposing stricter capital, requirements forcing institutions to hold larger buffers against losses, while mandating clearer reporting standards, so investors and regulators could monitor risk in real time. This dual focus on fortified equity and heightened transparency was designed to curb excessive leverage restore confidence among counterparties, and prevent a repeat of systemic failures that threaten global stability. We stand at the edge of an ever-expanding network, where markets no longer respect borders. Capital moves like breath, slipping through digital veins in a heartbeat, linking distant economies as if they were parts of a single living organism. In this interwoven tapestry, money flows instantly across continents, erasing old distances and reshaping how wealth is created, shared, felt by every soul caught in its swift current. From my perspective, the rise of emerging markets signals a profound rebalancing of monetary currents. Nations across Asia and Africa are no longer peripheral nodes, but central drivers reshaping how capital circulates, how currencies interact, how policy decisions ripple worldwide. Their expanding middle classes generate new demand that fuels credit expansion, while sovereign strategies diversify reserve holdings away from traditional strongholds. As these economies integrate deeper into global trade networks, they introduce alternative financing mechanisms, foster local capital markets, and compel established financial powers to adapt to a multipolar reality where monetary influence is shared across continents. Digital finance redefines how we move value, turning invisible transactions into seamless clicks that reshape everyday habits. Electronic payments dissolve the need for paper bills and coins, coaxing consumers toward contactless swipes, mobile wallets, online transfers that blend effortlessly into routine life. As these tools gain ubiquity, people grow accustomed to instant confirmations and real-time balance updates, making tactile cash feel increasingly obsolete. Habits are built on convenience and speed. Checking balances with a tap, paying for groceries through an app, settling debts with a few keystrokes, eroding reliance on physical money, and embedding digital avenues as the default medium of exchange in modern society. I stand at the edge of a new financial epoch where value is no longer sealed by central vaults but spread across a networked ledger that records every transaction in immutable blocks. Smart contracts execute themselves, turning code into enforceable agreements without intermediaries or trusted institutions, and cryptocurrency unsettles foundations of monetary authority, stripping power from sovereign banks and redistributing it to participants who collectively validate and secure the system. I see a future where trust is algorithmic, settlement occurs instantly across borders, and old hierarchies of finance are questioned by relentless logic of decentralized consensus. In this vision, the central bank issues its own digital tokens that live on a secure ledger accessible through any smartphone or basic mobile device. Bypassing traditional intermediaries, these tokens can be transferred instantly to anyone who possesses an identity and connectivity, granting unbanked populations a direct channel to store value, receive payments, participate in the formal economy without needing a commercial bank account. Because every transaction is recorded in real time, the central bank gains unprecedented visibility into cash flows, enabling it to calibrate monetary tools with pinpoint accuracy. Raising or lowering rates can be mirrored by adjusting digital token interest rates or reserve requirements applied uniformly across the entire population. This precision allows policy decisions to be transmitted instantly through the system, ensuring stimulus reaches households and businesses exactly when needed, while also empowering individuals in remote villages to receive government transfers, microthways, a fortune, savings incentives directly from the central bank, thereby fostering true financial inclusion for all citizens but pre-transmitted. instantly through the system, ensuring stimulus reaches households and businesses exactly when needed, while also empowering individuals in remote villages to receive government transfers. I stand before you at an invisible chasm, where the promise of prosperity is denied to those whose hands never grasp the lever of capital. When lenders favor already affluent borrowers, they extend lines of credit only to those who possess assets, allowing wealth to compound in privileged circles while marginalized communities remain shackled by scarcity. Investment opportunities become gateways reserved for a select few. Their doors opened by networks and collateral that ordinary families cannot conjure, leaving dreams of upward mobility to dissolve into dust of exclusion. This systemic bias does not merely reflect personal misfortune. It reshapes entire societies, embedding disparity into the very fabric of economic life, as those denied access watch fortunes amass beyond reach, reinforcing a cycle where privilege begets more privilege and deprivation breeds further deprivation. In this stark reality, the widening wealth gap is not an accidental byproduct, but a deliberate architecture built upon unequal credit and investment access. A structure that must be dismantled if true equity ever hopes to emerge. Imagine a world where the architecture of money itself becomes a conduit for fairness, where every issuance of currency follows an ethical blueprint demanding equity rather than mere efficiency. Such a framework would embed redistributive policies directly into the pulse of financial design, ensuring credit flows not only to those who can afford it, but also to communities long excluded from traditional capital. By weaving social justice objectives into mechanisms that create and circulate money, through transparent allocation criteria, accountable oversight, purpose-driven interest structures, we transform monetary systems from silent engines of accumulation into active agents of inclusion. This intentional alignment compels policymakers to view wealth distribution not as an afterthought but as a core principle, reshaping the relationship between economic power and societal well. The future unfolds as a seamless tapestry where intelligence anticipates every financial impulse, redefining services with invisible precision. Capital is no longer a mere commodity, but a living current that flows toward ecosystems and societies in need of regeneration, rewarding stewardship over extraction. The notion of value expands beyond balance sheets to encompass purpose, resilience, collective well-being, turning wealth into a measure of shared flourishing rather than isolated accumulation. And now, beneath the quiet hum of possibility, there is only stillness, a breath held in the space between tides, where the world rests in its own soft open hush.